we've assembled a number of experts from different Asian regions within different disciplines. And I hope that this session will be you'll find it both educational and interesting. First of all, we have Brett Cooper, Head of Commodities Asia from StoneX Financial. Sachin Patel, who's the Head of Commodities Asia for CME. Saad Rahim, Chief Economist and Global Head of Research at Trafigura. And Matthias Reiteg, Senior Officer at the Osaka Exchange. So within the framework of commodities in Asia, I thought it'd be best if we started with a more general view, a big picture view, before we came around to the individual components of the commodities in Asia. So I wanted to throw it open to Saad on, are we entering the new commodity super cycle now that we find commodities challenged both by trade war and COVID compression, shall we say?
Great, thank you, John, and thank you to the organizers for having me here. Just a quick word of introduction for those of you who don't know who Trafigura are. You may not be familiar with us. We are the second largest physical trader on both oil and metals. So I think for us that gives us a pretty unique, diversified perspective, in particular to answer this question about a new commodity super cycle. And I would say, yes, I think we are, with the obvious caveat that it depends on how demand recovers from here, following the fallout from COVID and what that recovery looks like. But to me, the real concern across most commodities is really an underinvestment on the supply side. And we really have seen that almost since 2014, 2015, when we saw both oil and metals prices really come off. And we haven't really seen that reinvestment that's needed going forward. It's not across all commodities, but I would say in particular, we're seeing it really around metals. As we move more into electrification, the electric vehicle story, grid build out, 5G, all of those things, even increased automation and robotics, all require significantly more copper and nickel in particular, versus what we can really foresee as supply that is committed and coming on. So for me, we're really looking at those areas saying, you know, to give you some context, an electric vehicle requires 4 to 5 times as much copper as a traditional industrial internal combustion engine. So if you think about that growth in EVs, what that's going to require, it's going to be very, very significant. Same thing, nickel going into batteries for EVs and so on. Oil, I think, as well, I think we have seen significant underinvestment. Really, the world has been gambling that U.S. shale would simply fill in any shortfall, any supply shortfall, any real demand growth. But that too has taken a major hit this year on the back of COVID, and to be honest, on the back of also some pretty poor returns for the industry overall. So if you look at, you know, there are a number of reports saying we could be short by 4 or 5 million, maybe even as high as 8 million barrels a day of production by 2025 versus where you would expect to be. So you really need to see prices, in particular the back end of the curve, come up to levels that will generate, you know, basically an incentive price for investment. And we're looking probably at something like $60 there. And I think you need to see that really come up before you can see commitment to new projects and that new supply coming on. So with all that in mind, assuming even a somewhat normal return to levels of demand, then I think we are looking at something that would set us up for a period of higher prices.
So taking that point there, you're talking about copper's going to be, copper demand for EV vehicles is 4 or 5 times higher?
Yeah, so when you think about an electric vehicle, the amount of wiring that goes into it, right? It's effectively a computer on wheels, right? It's really about battery management, power management, and all of that. And so the amount of copper that goes into that is much higher. And then when you include then the charging infrastructure and everything else, yes, it ends up being about 4 to 5 times as much.
copper prices are already under pressure. I mean, they're already moving into backwardation.
That's it, exactly. And I think what we're really looking for is for that incentive price to come in to be able to start filling in, because when you look out ahead, there's quite a large deficit that starts to emerge in terms of where we can see future mine supply versus where we think the demand projections will be. And I should add, on the back of this, we are seeing major stimulus efforts in China and in Europe in particular, really geared around more green energy, sort of new energy build out, and that again is going to be very, very copper intensive. But again, without real clarity on where we see the next tranche of supply coming in.
I mean, I didn't mean to speak about this now, but I mean, it's interesting that just since you mentioned it, I mean, the Chinese exchanges are bringing forward a copper contract that will be available for foreign investment before the end of October. Mm-hmm. So I understand. I mean, obviously that's subject to permissions emerging in China, but certainly that's the timeline that we as a company understand, and we feel that that's going to be, it's a bonded in warehouse bonded copper contract, and we feel that it could overtake the current contract in time to being the benchmark inside China for trading copper. It will be available to international investors through the overseas intermediary mechanism. But that's a thing that I'll get back to later. I mean, just staying on the metals theme for a minute, Sachin, have you seen a rise in metal trading in Asia at this time?
Thanks, John. And first of all, thanks to the other panelists today. It's really great to speak with you all, even if we miss out on the comfort of being side by side in a nice armchair on the big stage. But it's been a really great thing to look forward to, actually, and a bit of a change from the normal day of the last several months. So thanks to the organisers at FOW for putting this together. It's hugely appreciated. John, from your question about the metals complex at CME and what's going on in Asia and how Asia is sort of helping to drive the markets. Obviously, the sort of makeup on who is trading and when it's being traded is something that we're looking at CME pretty much all the time. And I think from a metals perspective, it's very clear that activity in this part of the world, both time zone and from the customer pool that we have sort of on our doorstep here in Asia, has become extremely important to in terms of its overall contribution to the overall business in the last few years. So just a little bit of a history lesson, I guess, and thankfully we're kind of out of this stage now. I feel one of the key challenges for commodity markets historically, especially metals markets listed on a US exchange, was to find a way to offer consistent liquidity across, we make the trading day almost as long as possible across a 23-hour trading day. And especially in a region like Asia, which is so important from both a consumption and a production point of view of a huge variety of metals, clearly it's a little bit suboptimal if we have a market where traders in Asia feel that they need to wait later on in the day to execute because of a perceived lack of available liquidity during what would be our normal trading hours. And so historically, there's been that mentality that certain things you need to wait until London are in. I certainly felt no differently several years ago when I was in my previous role. And that really has been a huge change, I would say, now in the last 3 to 5 years. And metals out of all the CME asset classes has been really one of probably, in fact, the quickest in terms of internationalizing the business, both in terms of client pool and times of trading. So just in a little bit more detail, usually we look at a few different things to assess how APAC trading is driving things in a global context. First one is very, very simple. We just look at liquidity conditions and volumes which trade during certain hours of the day. And if you take out a CME Group's big three on the metal side, so gold, copper, and silver, or gold, silver, and copper in that order now, what you'll find is that things like bid-ask and order book have tended to have a really consistent profile over the course of the whole trading day. If you have a look at the bid-ask right now compared to 10 a.m. New York time, you're going to see an extremely similar liquidity profile. So the fact that the market sort of looks and feels similar across the whole day in terms of those couple of liquidity metrics, by extension leads to increase the amount which is actually traded during the APAC day. So a few kind of stats for you. If we go back quite a few years now, back to 2011, roughly 25% of gold volumes were traded between market open up until 8 p.m. Singapore time, so really before New York hours. If you fast forward to this year to date, that percentage has increased to about 37%, and on a good day will be as high as 40 to 45. Silver and copper show extremely similar patterns. So I would say the amount that is being traded when we're all awake and working from home, it has increased several-fold over the last few years. The second key thing to look for is who is trading in terms of the different regions. And from the data that we see at CME for the metals complex, if you rewind again 8-9 years, you'd find that maybe less than 10% of our volumes globally were being traded by customers who were situated locally here in APAC. That number over the last couple of months, and I will say that the last couple of months have been an exceptionally strong time for the business in general, but has increased to about 20%. So two different things: trading activity during the Asia hours, and then trading activity from the different regions. And both of those metrics, from what I can see, have really been moving in the right direction, which suggests that Asia is starting to contribute a lot more to global metals trading. One final thing, and I think this is an area that we'll end up touching on later in the panel, is of course the product. Our benchmarks have been benchmarks for several years or several decades in the case of the precious metals and copper contract. But one really important trend that I think we've been seeing over the last couple of years, and John, you've just mentioned the bonded contract being launched within the next couple of months on INE, and that is having Asia relevant products which are listed on a global exchange. And we have tried our first step in that a year ago with our Shanghai gold futures, and I think this pattern of seeing regional benchmarks, particularly from China, start to gain more prominence, in the global markets, is going to be a really interesting theme to follow over the coming years.
Okay, well, just the bit that I heard loud and clear there was the increase in the total volume that people are doing, and the increase in total number of players from the Asia region. This is despite the trade war going on last year, or 2019. So you've seen this uptick relatively recently, you're saying. Any reason for that? Is that because they're getting into silver, or what are you seeing from your side?
Sure. So in terms of, there have certainly been obstacles, especially over the last 2 years with certain regions in terms of trading activity. But what we really have tried hard on is to diversify across as much of the APAC region as possible. It's a huge world which starts New Zealand and extends all the way to sort of the Middle East. And really, I think education has played a huge part in this. Perhaps going back to 10 years when CME Group was really starting to set up its operation in Asia, perhaps the name wasn't quite the household name which it is now. So I think, hitting the ground running and educating local clients who may have been gaining exposure elsewhere about liquidity, about the global client pool, has been one of the real key factors that have helped expand the amount that we see from this region. The other part is something which we obviously have no control in whatsoever, and kind of happens by luck or by fluke, and that's what the market does, and when it reacts to news. And I think certainly from our major metal markets, there does seem to have been a shift of some of the bigger moves happening overnight. Whereas again, I feel if you rewound several years or a couple of decades, the market activity, of course, goes hand in hand with when the trading activity is occurring. If you look at this year as an example, gold is a perfect example. So this year to date, it's broken through 1600, 1700, 18, 19, 2000. All but one of those big round number psychological, hurdle numbers. And the one exception is $1,800 per ounce. But 16, 17, 19, and then the magical $2,000 per ounce mark were all broken during Asia trading hours. And, I feel that this is the way that the markets have sort of gravitated, especially in recent years, where perhaps a piece of news or a tweet which comes in the afternoon or evening in the US obviously has its reaction from a market's perspective when Asia first opens up. So those sorts of opportunities have naturally lent more customers coming to CME from the liquidity providers who want to be involved in these markets to serve all of the end user customers that we have who need to risk manage their exposure. So I think those are the two sort of broad areas that have contributed to Asia growing its foothold from a metals perspective.
Well, thank you very much for that. Brett, I wanted to bring you in here because we've been speaking about the changes in metals and the impact of the metals markets. But the trade war had an impact on the agricultural market as a very influential effect on the agricultural markets. So who, in your opinion, were the winners and losers over the last 2 years?
Thanks, John. And it's likewise a pleasure for me to be here. I think if we talk about the two key protagonists in said trade war, they'll both tell you that they're the winners one way or another. But I think it's probably more interesting to look at it outside of the context of the last 12 months. I think for a significant amount of time, China's recognised as probably the major importer of commodities, and the biggest growth market, at least in terms of volume, that they have been exposed by having too much reliance on a limited number of suppliers. So for a number of years, China's been having to face the reality of being active, made the choice to actively sort of support alternative suppliers. And perhaps the events of the last, 12 to 18 months have sped it up in certain cases. So, if you look in the larger volume, the high volume commodity grain sector, from something like soybeans, clearly Brazil has been a big beneficiary of, China needing to buy more produce than they can from their traditional sources. And accordingly, Brazil's production's been increasing as well. So there's been a happy marriage there. Also, we've seen a significant increase in the last 5 to 10 years as far as Black Sea production as well. So particularly in wheat, and also followed by some other products like corn and soybeans in certain instances as well. So, I think there are always winners and losers, but the fact of the matter is that most agricultural commodities are annual products. So, year on year, there can be significant changes just because of seasonality, And I think the point is that, markets need to be able to adjust very quickly to supply shocks. And the supply shocks we've had this year on by COVID, are nothing new, in terms of what it's meant to individual origins.
So just going back to, just for me, obviously Brazil's been, as you just said, has been the biggest beneficiary, but also they're one of the highest numbers in COVID infection at the moment. Do you see that as going to be an impact on the production there, or not?
Yeah, I think it is, and it has. I mean, there's been reports of Chinese imports for specific products being, the packaging being infected by COVID from countries such as Brazil. So clearly there are, risks which are way above my pay grade, which exist in supply chains as it is. But if just going back to, I guess, my area of competency, yeah, they do. If we look at, again, not to focus entirely on China, but it's a key player. I mean, if you look at China's purchasing activity this year from the US, they've certainly been, aggressively buying from the US. Now, if you look at something like soybeans, they typically spend half the year buying from the US and half the year buying from Brazil. They're probably, with the expectation of a very big Brazilian crop, being quite aggressive. They've also been quite aggressive in buying in US corn. Now, there is the background of the existing Phase 1 trade deal between the US and China. So there is, I guess, some commitments to make those purchases, which perhaps might be a little hard to do even from a purely economic perspective. But the fact of the matter remains that it actually has generated a couple of questions in terms of China's behaviour. One is, are they buying aggressively because there is, genuine demand recovery, quicker than what most people would expect, given what's been happening in the last 6 to 8 months? Is it because they're wanting to build more reserves, because they've drawn some down, but also because they expect that there is more risk of supply chain disruption over the last 6 or 12 months? And I think the answer is a bit of both.
I think clearly supply chain disruption is a theme that is going to play out for a long time as we learn more and more about the infection and how it impacts us economically. Matthias, I just wanted to bring you in as well. I mean, obviously the Japanese trading houses have had a very big investment recently, and obviously that's something to do with the Japanese market and the Japanese place in trading supply chains. That those big investors saw an advantage to take a stake now. I mean, how do you see that and the wider Japanese market within the commodity space?
So first of all, thank you very much for having me here today. Right, for us, the whole commodity space is still very new and fresh, since we just managed to migrate the token market into the JPX group. But yes, the investment you're just alluding to, right? Obviously, that is something that is that only the Oracle from Omaha would know, right? How to answer that. But I do think actually that, of course, it's quite smart, right? In that sense, as you just said, rightfully, right? The Japanese Sogo Shoshas, so that the Berkshire Hathaway made an investment in. They are very well positioned globally to after this whole COVID crisis. They're probably the fastest to switch on everything, and with a very strong network of cross holdings and joint ventures, they will be very fast to deploy the demand for commodities quickly. And Japan, for all its worth, is still an industrial powerhouse. And from that perspective, I think once demand comes back, then or production goes up again, right? Also, the other themes that were just mentioned before, like robotics and electric vehicles, is something where Japan is fundamentally quite strong in, right? And going forward, obviously, they will benefit from the strong positions of the Shoshas to source these commodities globally, right? But also they're very interwoven with international players, right? So in a certain way, Japan is the middleman between the US and China as well, and they can also play quite a nice part there. I would also like to raise that, for example, Mitsubishi was one of the first companies that ever transported LNG from Alaska to Tokyo, and there's all sorts of discussions about whether that investment is kind of driven by the holdings that they have in the LNG space as well, where the Shoshas are also very involved. Another thing that is very interesting about these companies, of course, we see a global retreat from banks in particular in terms of financing. So we are more from the finance side, but obviously there's some sort of a retreat from the commodities financing space. And the Shoshas, for example, they can basically fill that gap to a certain level. And yeah, it's certainly probably a strong and smart dividend play that they are doing there. But going forward, I think their role will be more prominent, just also because of all the complexities, all these new complexities, where it's more difficult for smaller players to survive going forward.
So have you, specifically at your exchange, you got anything new coming for the commodity space in the next year or so?
Yeah, we're working on a few things, right? Obviously, I mean, the integration is still new, and we're launching a new system in fall next year, right? Which we call JGate 3.0. That is obviously something that keeps us busy, right? Also, I just wanted to raise a little bit what my fellow speaker from CME just mentioned is that the rise of retail flow basically in this region, geographically, obviously, and also our proximity to China and other geographies here in Asia that are in that sense very commodity driven, very knowledgeable about commodities. So we're very happy that also, of course, our night session trades very actively. And the commodity is just a great addition to that space. So we do see, for example, a transition from our active mini Nikkei traders for retail traders into the gold contracts, for example, that we just launched. So that's fairly new for us. That goes quite well in terms of growth also. And for new stuff, yeah, of course, so the electricity market that we just launched, right, is something that is we get a lot of interest, but it's slowly developing. So this is a longer term project, obviously, and will take time.
Okay. I mean, I think, I come from a time when Japan was extraordinarily influential on every level, and to find that investment going in from the US to those trading houses was not only surprising, but it was reminiscent of, of the middle 80s rather than where we are in the 2020s. I suppose, the reason I asked that question about new products coming from Osaka, what about you, Sachin? You got any new products coming from the CME in the immediate future?
Sure. So there is nothing to sort of be able to make an announcement on right now in terms of new things very imminent in the next few weeks or couple of months. We've had a relatively busy last 12 months, I would say, in terms of new new initiatives, and they stem from quite a lot of the things we've already discussed so far this afternoon. So the first one, which I mentioned briefly, was the Shanghai Gold contract, which cash settles against the Shanghai Gold Exchange's benchmark price. This for us is a hugely important thing for our gold business. I think CME, from a listed derivatives perspective, have been very much a household name and the leader of liquidity for a number of decades now. But China has emerged extremely quickly as being the largest physical trader or physical user of gold. And the Shanghai Gold Exchange, in just a few years, is already the largest physical exchange. Now, each region, gold is something which historically has been, I guess, a little bit more homogenized. It tends to be easy to move around the world. It doesn't take up too much room to store, etc. But still, given the nature of the markets, each region does have its own different sort of fundamental drivers. So our aim here was to take out, the current contract or our current market with COMEX Gold, and offer CME Group clients a way to sort of have that link or bridge the link between the world's largest physical market and the world's largest international derivatives market. So that was very exciting news last year. It's had a pretty good first 11 months with client types across the board, banks, funds, proprietary traders, all being involved in this contract. And, you know, based on the success of that, of course, looking at some of the other metals which would naturally have that onshore, offshore, arb or spread dynamic to it would make sense. The other thing from earlier this year was launching of an enhanced delivery contract for COMEX Gold. And, you know, this arose from the metals market's own supply chain issues, which occurred during, you know, March and April time, COVID related. All of a sudden, as I just mentioned, gold is usually extremely to move around the world and re-refine in terms of bar sizes. And then all of a sudden, for a period of a few weeks or even longer this year, it wasn't. And that caused, you know, a regional basis, which is usually exceptionally stable between London and New York, to blow out to levels which I believe were never seen before. So that was our response to offer a contract which, in a similar situation going forward, would help alleviate some of the bottlenecks that we saw during that time in terms of how to deliver gold to the CME. And the new contract offers an expanded bar size and an offered location. So from a gold perspective, those have been really the two exciting things that we've had on our plate for the last 11 months.
Sure. Just to go back to the agricultural specialist, Brett, for a second. I understand that there's a new Brazilian FOB soybean contract coming out. I mean, will you be using that? I mean, it does say something about the way that that market has changed, that's having to, you know, that's now an American exchange.
Yeah, absolutely. I think, you know, as I alluded to before, global supply chains are changing, and you know, the people's ability to hedge and manage the risk of those different supply chains should alter over time as well. So yeah, the CME are launching their new FOB Brazilian soybean contract next week, which I think is a fantastic initiative. It's a cash settled contract based off a Platts index, which the CME has done. It was used to follow a similar initiative or similar methodology to launch some new contracts over the last couple of years. They've launched a Black Sea of wheat contract, for example. But you know, for people that have exposure to Brazilian soybeans directly, or people that want to express an opinion versus of Brazilian prices versus US prices, I think it's a great new initiative.
Yeah, well, markets are always changing. I think you know, it's one of the things I'd like to talk about for just a moment. My interest is cross-border arbitrage, and I make no apology for that between China and the rest of and the international markets. Now, that's been going on for some time. We've had the crude oil contract, we've had the iron ore contract, and I've alluded to the fact that we expect to see a copper contract coming before the end of October. Now, these contracts can be used by foreign investors, and you can use dollars as initial margin. But the takeoff of these contracts, or the takeoff by exterior investors into these Chinese contracts, has been relatively slow, considering that iron ore has been there and crude oil has been there for 2 years. So I think that one of the reasons for that has been the way that people can trade it. And I think that's one of the things we haven't spoken about actually so far, is previously access to Chinese markets has really been only through Chinese trading apps. You can have a trading app from any of the people like ourselves and many of the Chinese onshore brokers, and you can get access. But the fact is that knowledge about that, once you go west of, say, Singapore, has been very, very low. And certainly Western trading houses have been very cautious about bringing other trading methodologies into their trading rooms. However, that is just about to change. I mean, the Western products like CQG and TT. The TT's got it in test and will be coming fairly soon, I hope. CQG are already offering it to clients. They are now offering the ability to trade through them using the appropriate broker straight into the Chinese exchanges, where the liquidity can be extremely high. I mean, iron ore trades 1 million lots a day. So what I foresee is by the time we do this conference next year, quite a different complexion in the way that we talk about the markets. Because at the moment we kind of separate it off. We separate the international markets and what's happening in China as if they are two separate markets. Well, they kind of are, but they're not going to be, and especially for those contracts that are largely imported. Iron ore, crude oil, they've done. Copper, that's coming along. Zinc will come after that. And later on, I'm very sure that we'll see the soybean, complex in some manner, also being offered as well. I don't think anybody in the Chinese exchanges would disagree with that. The question of timetable is always a question, but it will happen. So I'm interested in that intersection, where that market is. And I mean, going back to Trafigura, you guys, you've had a WOFE in Shanghai for a very long time, WOFE being a wholly foreign-owned enterprise, and you are present in the Chinese market. But that's people are going to come. People are already planning to trade the same sort of markets as you're already in. How do you see that? Do you see that appearing? Are you thinking about that already? How that may change the kind of margins that you see at all, or not yet?
No, it's a great question. Where we have absolutely seen, anytime China launches a new contract, really of any kind, the liquidity of those instruments really goes through the roof. And sometimes it does take a while for, as you say, external investors to come in on some of these things where they can. But generally, we found it to actually be really, I think, very positive development in terms of, again, not just liquidity, but price discovery, our ability to then get a better gauge on what's happening in the domestic market. You take something like crude, where now you're getting the physical deliveries that are coming in behind some of those contracts. So it really does, it does provide a whole new way for us to gain insight into the market, for us to be able to interact with those markets. And so for us, it really hasn't been a question of any sort of margin compression. It's really, in fact, been the opposite. Really being able to look at that and say, okay, this is something that helps our ability to deliver, again, that physical side against what we now know to be happening in those markets.
Yeah, because we did see it earlier this year when the WTI went into negative numbers and Brent was still at 18 or 19. The iron oil, which was trading at 38,
right.
And any Westerner, any company could have sold into that if that wasn't exclusive, if they'd had the appropriate access. Yeah, so I find that's I don't think that's going to happen again. but it was an opportunity.
Probably not that spread, but I mean, definitely, yeah, exactly. And I think that told us a lot about the health, actually, of the Chinese market. We saw China recovering earlier on. We've seen them buy record amounts of then physical crude oil to be delivered into China. In fact, you've got quite a bit of port congestion against that. But it was really telling you exactly what was happening, right? With the brunt of this was really happening in the U.S. The rest of the world maybe was starting to recover, and China had already recovered, right? and both from a sentiment and a physical perspective, I think that was certainly the case.
Yeah, I mean, my own feeling about the V-shaped recovery, and I'd be interested for everybody's opinion actually. We're all located in different parts of Asia, and we're all seeing, you know, different elements of the recovery. Certainly here, the feeling is that it's a V-shaped recovery, and we're going up the upward leg, but we are not returning to anywhere near the same place. So that, you know, it really is a different world, albeit a one that's growing at a very fast pace here, recovering at a very fast pace here in China. As a sort of roundup here, as we've at the moment, what do you see for the next, you know, the next year? Well, and I'm going to ask everybody that question just before we finish this part of the chat.
Well, maybe so for us, even back in March, we were saying that this was going to be a reverse square root recovery, that you were going to come off very, very sharply, that you would inevitably rebound sharply just because you had fallen so much, but that you would then level off at a level that was somewhere below where you had come into it. Just because of, I think, the unemployment overhang, in particular in the U.S., I think, you know, what the kind of the debt burden that was going to be taken on. Now, the point is, and I think as you've alluded to, John, I think that level is going to differ by region. So in China, that level looks like it's very much almost back up to where it was. Europe, by and large, actually, especially surprisingly a little bit, given what it went through, you know, with Italy, with Spain, et cetera, has come up almost again, you know, to where it has been. But the U.S., India, these places really lagging quite significantly versus where they have been. And to me, if I look at it, where, you know, after 2008, it took 7 years for jet demand and for gasoline demand to recover to the previous levels. So if you go by those as a guide, then I mean, we're a long way from that recovery, I think, coming to the fore. So I think you're at this reduced level. And then one last thing I'll say is, you know, the way we've been talking about it is to say, look, you know, it sounds like a small difference, but a 98% recovery for the oil market, for example, is maybe, you know, it's something like a disaster, because you're saying that's 2 million barrels a day of demand that has disappeared. A 95% recovery sounds pretty good given where we were, but again, that means that you've lost 5 million barrels a day of demand. You know, that's a very significant move for the oil market, and then again, you can play that across any of the commodities. So for us, I think, you know, we really need to see things pick back up from the levels that we're at right now, for us to really say that, you know, the demand side of things has really recovered.
Cool. Okay, Sachin, what do you see for the next year or so?
Sure. You know, just keeping within the markets that I sort of have my eye on most keenly day to day, and those three metals, gold, silver, and copper. So copper is maybe a natural one to start with, because the recovery there, you know, so, or its price action for this year just is quite an amazing thing to look at. To think that the market traded below $2 per pound for a little while in March, and now is comfortably back above $3 is just amazing. And that really does seem, you know, to me to have just been almost an entirety driven by China itself. Yes, there have been some supply concerns along the way in some key producing regions. There was a positioning element to this as well, where everyone that was short the COMEX market has maybe flipped to net long now. But from a fundamental perspective, obviously, the numbers that we've been seeing from China in terms of their imports in particular for the last 2 or 3 months now have just been really a sight to behold. So looking forward for the next year, if you look at the three major regions of the world, if you want to call it that, the USA, the Eurozone, and China, you know, one of them seems to be firing on all or most cylinders at the moment, with the other two perhaps some way behind. And, you know, whether or not the China element is enough to keep keep copper going. I'm not sure, and certainly not my place to make a prediction, but seeing any additional demand recovery from some of the other global regions will be a key thing to look out for. As for gold and silver, just briefly, inflation. We know nominal rates are at or near zero, and with the unprecedented amount of monetary and fiscal stimulus that we've seen, inflation kicking in, if it does, in a meaningful way and driving real rates even lower than what they are now is maybe the biggest thing that those two precious metals have going for it, and silver would probably be doing it in an extremely amplified manner. So yeah, that's kind of my take on things for the next few months.
Thanks for that. Matthias, what do you say?
Well, for me, I mean, there's not much to add to my colleagues there, right? But I think, of course, since we don't have the crystal ball, we must look at what we get. But it's certain that it's going to be more volatile for sure. And what I also think is the flight for quality will continue, right, regardless of the outcome of the election, right? Because of post-COVID, once we overcome it, I guess people will look into the books and look at all the money they printed, and will find innovative ways to get it back somehow potentially, which is very scary, right? On the other hand, is also, of course, how long people or central banks will continue to play this game. So, yeah, certainly there will be more demand in terms of diversification, right? As terms of asset protection is a big theme, right? Of course, across the globe. And from that perspective, I think we can be quite bullish on the metals part. But yeah, it's going to be quite choppy, I think.
Okay. Brett, what would you like to add?
Yeah, I think, in broad agreement, everything that's been done, as far as to defibrillate the global economy in the last few months actually creates a longer stimulation or stimulant for production than it does demand. Overlay that with the fact that you sort of had low energy costs, low energy prices, low currencies. You actually, in my world, in the agricultural soft commodity world, you had really, really good terms of trade stimulating production as well. So, you've certainly, we've seen China as a great demand story, but I think that the lag and this hangover of production growth, assuming the weather, plays its part, is going to be something to contend with across most agriculture and soft commodity markets in the next 12 months. There are a couple of really interesting outliers which might, prove me very, very wrong. And as Matthias said, that's what's great about crystal balls is I don't have one. I wish I had brass ones, I guess. But at the end of the day, I think that we just can't take the demand recovery for granted. But going back earlier on, one of the parallel to Saad's earlier comments is that there's a lot of commodities, agriculture and soft commodities, that are at or near or better than their prices pre-COVID. And I think that is probably a little bit preemptive in some cases.
Sure. Okay, well, just to wrap up just for a second, thank you all very much for coming on. Thank for the people who are currently watching. My own view, I look forward to dollar weakness. I look forward to commodity price inflation. I look forward to, that those two will certainly do me. So I would very much welcome your questions for the five of us.
Here's the first question. Which new Asian commodity trading products make the most sense? Anyone interested to attack that topic?
Shall I have it? It's John here. It's an interesting question. I mean, which make the most sense? For me, it would be the new products coming out of China. Essentially, what they're trying to, there are 50 or so commodity products in China. Of those, the ones that are basically imported, I believe eventually will come to the market as internationally investable. So you've already got crude oil, iron ore, we may soon have copper, we have fuel oil. Essentially what it is that what the authorities are trying to do is make sure that the internal price inside China is adjacent to international norms. Previously, the way that the market's moved inside on the mainland, unattached to international prices, meant that the prices inside in China could be either very expensive for consumers or underpriced for producers. So by bringing the contracts into the overseas intermediary route, which is a way that external investors can invest in the commodity markets of China, it makes sense to sort of basically unify those two pricing venues. Eventually, those prices will be used as benchmarks right across Asia.
Sad, any thoughts?
No, I mean, I'm broadly in agreement. Actually, I think the framework of saying, some of these the products that China is launching, I think, make a lot of sense. One of the ones I would have added, maybe, one which didn't get a lot of traction, but I mean, just we had the Singapore sort of LNG contract, something like that. I think could make sense eventually. You need to get a more, I'd say, liquid market around LNG, because just the way it's always been priced has really been in relation more or less to oil rather than allowing, I think, better price discovery around that. So I think that could be something that could be interesting. But generally a comment, and I think we made this during the panel, was just, whenever we do see new contracts, particularly in China, but I think generally in Asia, the liquidity generally has been very, very strong. And so it tells you that there's a lot of pent-up demand, a lot of appetite for new products like that.
I'll move on to the next one because it's kind of related to what you guys were saying. Do you think the China-US tensions will dampen the commodity demand recovery in the near future?
I can start off on that. Just look from the physical side. What we're seeing is at the height of the trade war, yes, it did dampen demand. We could see that. You could sort of see that global growth generally had peaked around Q2 of 2018. And then demand for most commodities had come off, and especially in 2019, things have slowed down quite a bit. But to be honest, I think now we're saying I think we're past that phase of that having the same kind of impact, especially if we're in a rebound phase. Then the demand has definitely held up, I think, very well. And unless there's a new sort of escalation in this, for right now, I think the effects are by and large gone. But I'll leave the others to comment as well.
Just to add to that, I guess I think I'll comment on a drill down to on a market by market basis. But at the end of the day, if you're talking about the impact on demand from the US-China trade tension, it really depends on what is the absolute need of the protagonist. Yeah. So, if China has elastic demand and there is trade tension with the US or anybody else, they will have the flexibility to either reduce demand or find alternatives. And I guess that's a feature, as we touched on in the panel, of commodity markets in general in the last few years. There's been a lot of energy spent by people making sure that their demand is as elastic as possible. There's alternate supply chains or origins are as many as possible. So, what it does do is any trade tension forces the parties to find alternative origins or alternative homes. So, that's the end result. And at the end of the day, from a market transparency and flexibility perspective, it actually makes things more exciting from my perspective. And just to add a point to the first question, in my world, I think that changing of trade flows really puts pressure on exchanges and market solution providers in general to find better alternatives, because as these supply chains change and adapt, hedge effectiveness in some of the old ways can decline. We see the CME are releasing a FOB Brazilian soybean contract next week. Who knows as far as whether or not that gets significant traction early on or not. But I think it's an obvious reaction to the fact that, China, for example, buys half its soybeans now from Brazil. So, it has the potential to be as good or better hedge mechanism for that demand, not just in China, but the rest of Asia, then, the old-fashioned way of just Chicago soybean futures. So, markets need to adapt, because I think
I think that people's needs adapt. Thanks.
Yeah, if I could add on to the second question here, actually, and the effect that the trade war, the trade tensions have had on demand. And I think over the course of certainly last year, if we look at the copper market, prices, became pretty depressed and were not moving around too much. And it seemed to be quite obvious that overriding tension was having that dampening effect on the market. But, fast forward to this year and the last few months, where I guess you can't really say that underlying tensions have dissipated exactly, but we have seen this just exceptional pickup in Chinese demand, successive months of record import numbers for their refined copper, and the list goes on. So kind of modeling demand from a copper point of view, using, the trade war and trade tensions as a variable would certainly have been a little bit difficult, because we seem to have seen a couple of different stories. Then we look at the gold market, and there's a really interesting dynamic going on right now, which is very, very unusual, and that is that the onshore gold price, the Shanghai gold price, is pricing at an extremely steep discount to the international gold price, represented by our COMEX gold contract. And there does seem to be a complete lack of physical demand from China over the last few months. China is the largest source of physical demand in the world, and anecdotally from speaking to the market, it's sort of been explained as that appetite for gold, and why ordinarily a consumer would be buying gold just seems to not be there at the moment. In China, the prices are already at or near all-time highs. There doesn't seem to be potentially as much need for gold from a safe haven point of view, and so you've kind of got this dislocation in prices between onshore and international. So it's definitely interesting on two of CME's bigger markets, and certainly some different stories that you can draw from both of them.
Matthias, have you noticed?
Yeah, I mean, per se, not specifically for China, of course, right? But in general, I guess as a byfunction of the global, how can I say, confidence in currencies going forward, right? Obviously, we see some sort of reversal, of course, in trade flows, right? Where precious metals are being sourced in Asia and then being shipped back to the US or to Europe. And that is something which is kind of interesting as a dynamic. But I just wanted to touch point on the previous point as well, on the previous question, just with regards to how we look at the global currency to settle commodities, right? Whether it's going forward with this trade war continuing, whether there are better alternatives, or whether actually the dollar is gonna be the ruling currency going forward there, or whether we see some de-dollarization in some of the Asian countries, for example, right? That's somewhat interesting to us to see whether we can find products with better specs that actually better replicate the market demand going forward.
Super, super interesting. I've got a few more questions, but we've run out of time, I'm afraid. So please, everyone, if you've got more questions, go find these amazing panelists, so knowledgeable, super interesting. They will be on the platform, and I'm sure they're more than happy to answer your questions.